We think that roughly 50% of the S&P 500 is at risk of creative destruction. Some more, some less, but 50%. And what does this mean? What we think is going to happen here for those companies who spent the last 20 years catering to short-term investors who wanted their profits and wanted them now, companies were leveraging up to buy back shares, pay dividends, and they were not investing enough in innovation. In fact, many didn't take seriously the idea that innovation was a threat. I know when we started ARC in 2014, auto manufacturers, auto analysts thought, this was something for the mid-20s, maybe. And we were looking at the cost declines in battery pack systems, and we were saying, nope, this is happening now. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life. So we're going to see a lot of that in financial services, energy. So the two sectors that have done best this year, we believe, are two of the most vulnerable sectors. In the energy space, we think that electric vehicles, and especially autonomous electric vehicles as they launch within the next few years, are going to put a big dent in oil demand. And within financial services, we see digital wallets evolving so much faster than I think anyone could have dreamed. China showed us the way through WeChat Pay and Alipay, and now Square's Cash App and Venmo are moving so quickly that their user base has scaled well beyond JP Morgan's customer base in just a few years, in the last 5 years, whereas JP Morgan got to this level one acquisition at the time. The digital wallet evolution or revolution has gone viral, and there's a social networking element to it. So very interesting space. And so financial services buyers beware. That's the bad deflation. Those companies that are too leveraged and have products that will be obsolete are going to have to sell those products at a discount increasingly in order to service their debt. So good deflation on one side associated with an innovation, and bad deflation associated with the creative destruction caused by innovation. The third source of deflation that we believe will take place maybe toward the end of this year, probably more likely next year, is commodity deflation. We believe that there is a lot of double and triple ordering taking place right now, and companies never quite know if it is double or triple ordering. I think supply chain management systems are getting better, so maybe it won't be as bad as it has been historically. But we do think that inventories will build to a level well above demand sometime next year, and that the unwinding of them will cause an unwinding of commodity prices. That said, we want to keep an open mind here. When I see a breakout from a 20-year base, as we've just seen in copper, I pay attention. Now, on oil, we have not. And in fact, $140 was the peak in 2008, and every peak since then has been at a lower level. So I'd be very surprised if we go above that level. If we do, then we will, score another one for the inflation risks are picking up. The other thing we're watching is the dollar. To see the dollar break down would be somewhat concerning. Now, the dollar is priced against other currencies. So part of that is a function, perhaps, of our monetary policies relative to those elsewhere in the world. And just on that note, I will say the country that has handled this crisis the best in terms of not throwing money at it willy-nilly is China. And I think that will accrue to their benefit in the years ahead. So I would say watch that space as well. So with that, I just wanted to call out some of our thoughts. We do believe deflation is the bigger risk. The reason I like being on that side of the bet is that it seems like everyone is on the other side. And usually, if that is true, then if we're wrong, then inflation has been or is being discounted in the market right now. So we'll be perhaps uniquely wrong, and it's good to be uniquely wrong. If everybody else expects one thing, then it's probably getting priced into the market. But I think these three sources of deflation are going to throw economists off. As I said, I remember feeling very confused in the 06 period. Interest rates were doing this while commodity were going down, while commodity prices were going up. And so it's at these times that if you do take a stand, differentiated from the crowd, for good reason, not just to be contrarian, the payoff can be enormous. And in terms of the recent behavior of value stocks, especially those that we believe are in harm's way, compared to the severe drawdown of innovation-oriented stocks, I like that setup very, very much. We have a 5-year time horizon, as do most focused on long-term innovation. And those strategies generally, according to our analysis, suggested that innovation would reward investors, again, if the analysis, top-down, bottom-up, of the possibilities associated with innovation are correct, would deliver a 15% compound annual rate of return over the next 5 years. Well, nothing has changed. Nothing has changed except the stock prices have come down. We're in bargain basement territory if our view on innovation is correct, the 5 innovation platforms. So if the return expected at the beginning of all of this was 15%, then the return expected now, again broadly, should be in the 25 to 30% range per year on average during the next 5 years. I love the setup, and we do think the bull market has broadened out, and we're looking forward to innovation joining the party once again. Well, the stimulus, the first part of it is in place. We're seeing it come through the economic statistics as well. And it does look like we're going to get somewhat of an infrastructure bill, which may include tax increases, but I think the odds there are going down. The closer we get to the midterm elections, given how razor thin the margins are in both the House of Representatives and the Senate, the lower the likelihood of significant tax measures. It does seem, according to the University of Michigan, that inflation expectations have picked up a bit when looking at a 1-year time frame. In fact, businesses continue to scramble. They cannot keep up with what's going on out there. So what is going on if businesses are scrambling and can't meet demand? What is going on is if you pay people not to work, they won't work. And I think a lot of companies are having trouble finding help. And in fact, one of the important clues of that is, and I've never seen anything like this, is temporary employment dropped. It tells us, though, that those companies who have hired temps and realize they cannot find employees on a permanent basis, they are luring the temporary employment, the people who are working for them temporarily, they're luring them in probably with some pretty good packages. And what we saw in average hourly earnings would confirm that. Leisure and hospitality is picking up dramatically now. Those wages, the wages for that category of employment, are much lower than average. So the mix shift should be pushing down average hourly earnings, maybe not putting them into negative territory, but flat to up 1 or 0.2% per month. We think that's temporary, that when this stimulus package runs out, that will correct. But for right now, that is feeding fears of inflation.